Now that you've distilled the code sections into a workable formula, it's time to apply that formula to our facts so that we can determine the tax consequences to Mitch and then ultimately to you. So the first step in determining gains from dealings in property is to determine what is the taxpayer's basis in the property. Everything turns on basis. That is the key to the analysis. So what is Mitch's basis in the XYZ stock? Well, Section 1012 tells us that generally it's cost. What was the cost? $1,000. Mitch used borrowed funds to acquire the stock, but does that matter? No. Tax law gives basis credit for using borrowed funds to acquire property because the taxpayer will have an obligation to pay back the borrowed funds. Now, what if Mitch used jewelry worth $900 instead of borrowing $1,000 to acquire the XYZ stock? You might initially say that under 1012 the cost would be $900, so his basis would be $900. But that's not what Philadelphia Park Amusement tells us. It tells us that for tax purposes, cost under Section 1012 in a sale or exchange is the value of the property received, notwithstanding that the value of the property given up in the exchange might be different. Therefore, Mitch's basis in the XYZ stock is $1,000, even if Mitch used $900 worth of jewelry to acquire the stock. Now recognize that having disparate values in an exchange is extremely rare. In most of the cases, the values of the exchange properties will be equal, certainly when the parties are dealing at arm's length. It's only in the very, very, very rare case where parties are dealing at arm's length and the properties clearly do not have an equal value that Philadelphia Park Amusement comes into play. So make sure you keep that in mind. In almost all cases, the exchange, at least again if it's at arm's length, will be with properties having equal values. So what is our basis? Our basis is 1,000. And I'm going to use a negative number to represent that because we're going to be subtracting that number in a moment. Okay? Okay, now, how about amount realized? Well, Mitch exchanges, well, first of all, how about in year 2 when Mitch pays off the loan? Does that affect basis in the property at all? And the answer again is no. That the fact that the loan is repaid has no effect on the property's basis. It is true that Section 1016 talks about adjusted basis, but those adjustments are not for payments of liabilities that were incurred in acquiring the property. Rather, they would be adjustments for things like improvements to the property, capital improvements. We'll learn about those later in the semester, or depreciation. We'll learn about that later in the semester too. So right now, there are no adjustments to the basis, to Mitch's basis in the stock, as a result of the payment of the liability. Then in year 3, Mitch exchanges the XYZ stock for ABC stock. The ABC stock is worth $3,000. What is Mitch's amount realized? $3,000, the value of the ABC stock. Section 1001 tells us that. How about, so therefore, 3,000 amount realized minus adjusted basis of 1,000 results in gain realized of 2,000. Is there any non-recognition exception here? No, we assume that away. So no adjustments for non-recognition. Gain recognized equals the gain realized, since there's no exception to apply, and then therefore 2,000 is the gross income to Mitch under Section 61A3. Now, let's turn for a minute to the second alternative where Mitch uses the stock to pay his daughter's tuition for law school. We learned at the last class that satisfaction of a liability can constitute income. So satisfaction of a taxpayer's liability by another can constitute income to the taxpayer. Well, similarly, satisfaction of a liability with property, if that property is appreciated, can constitute income. Why? Because the amount of the liability is an amount realized. Liability relief under Section 1001 is taken into account as part of the amount realized. Now we have an additional question here because of the way the transaction was affected, which is, did we actually have a gift to the daughter of the stock, followed by a transfer by the daughter to Georgia State to pay tuition? Because the tuition is the daughter's responsibility, not Mitch's. Or do we simply have Mitch paying some sort of obligation on behalf of his daughter? We'll see in the next chapter how these types of transactions will be treated, but the best way to think of it is that as if Mitch transferred the stock to his daughter. That was a gift. We'll see how gifts are excludable, so it's not going to be income to the daughter. And she'll take what's called a carryover basis, more on that later. But all you need to know for the moment is that if the daughter had used the stock to pay her tuition, she would have been paying a liability of $3,000 with stock in which she had a $1,000 basis. So therefore, the gain realized and recognized in this scenario is exactly the same. Now, what about if Mitch borrows in year 3, borrows $1,000 on the stock and then transfers it to you in payment of $2,000 worth of legal services? Well, here again, the amount realized is $3,000, but it consists of 2 elements. First, there's the liability relief, because if you look at Section 1001, when Mitch transferred the stock to you and you assumed the debt, that constitutes an amount realized to Mitch of $1,000, plus Mitch received $2,000 worth of legal services. So therefore, the amount realized here is also $3,000. Oops, pardon the error. 3,000. Okay, so in all 3 scenarios, Mitch's amount realized is $3,000, his adjusted basis is $1,000, the gain realized is $2,000. Realized gain will be recognized absent a non-recognition provision. There is none here. So in all 3 scenarios, Mitch's gross income under Section 61A3 is $2,000. Now let's go back for a minute to the exchange. What is Mitch's basis in the ABC stock acquired? Well, if you think about the Philadelphia Park amusement case, it should be $3,000, right? In a sale or exchange of property, the taxpayer's cost basis and property received is the fair market value of the property. It was $3,000, the ABC stock. That also makes sense, though, because Mitch started with a $1,000 basis. He had to realize and recognize $2,000 of gain. $1,000 plus $2,000 is $3,000. If Mitch turned around and sold the ABC stock for $3,000, we shouldn't require him to recognize any further gain, right? It's only if the stock appreciates over $3,000 that Mitch should have to recognize gain. So in fact, his basis is $3,000. Now what about in the situation where Mitch has transferred the stock to you for legal services, $2,000 worth of legal services? What is your basis in the property? Well, again, under Philadelphia Park amusement, it should be $3,000, right? The fair market value of the property received by you for legal services. But did you have $3,000 worth of income, gross income from those services? No, you assumed a liability of $1,000, and then you received an additional $2,000 of equity value in the stock. So your income, and if you look at the regulations under Section 61, it tells us that in an employer-employee relationship or with an independent contractor, when property is conveyed for services, the amount included in gross income for the service provider is the difference between what the service provider pays and the fair market value of the property. Here, the assumption of the liability by you counts as a payment. So $2,000 is the amount of your gross income from the receipt of this XYZ stock. What's your basis? Well, again, it should be $3,000, right? Because that's the value of the property you've received. It also makes sense because you had $1,000 of liability assumption and $2,000 of income. When you add those two together, that's $3,000. That $2,000 amount sometimes is referred to as tax cost basis. In other words, you were taxed on $2,000 in your gross income, so you should receive basis credit for that amount. All right, now that we know your basis in the stock, what happens if you sell it? Well, your basis is $3,000, right? If you sell the stock for $4,000, that's going to be your amount realized, resulting in $1,000 of gain realized, absent a non-recognition provision. That realized gain is recognized, so you have $1,000 of gain. So all in all, over years 3 and 4, your income from this property would have been $2,000 for your performance of legal services, and then $1,000 for gains derived from dealings in property. Make a note here that the $2,000 was not really Section 61A3 income. It was instead Section 61A1 income, compensation for services. This $1,000 gain in year 4 is Section 61A3 income, gains derived from dealings in property. Okay, hopefully that makes sense to you. If not, I suggest you go back through it again. And then after this frame is finished, you will notice I have put the answers in a PDF file at the bottom of the screen. Okay, we will be discussing gains from dealings in property in our next class. And I hope you have found this Prezi